Peloton shares are rebounding slightly this morning after taking a big tumble yesterday. Last night, the CEO, John Foley, warned about possible layoffs in a letter to employees, but denied a CNBC report that the company was temporarily halting production of its bikes and treadmills because of falling demand. It called CNBC's report incomplete, out of context, and not reflective of Peloton's strategy. We're joined right now by an analyst who's been bearish on the stock for some time. Simeon Siegel is a senior analyst at BMO Capital Markets. So, Simeon, you've been thinking for a while that demand was cooling. What did you think, first, of the report that said they may be cutting production because of slowing demand, and then, secondly, what the company had to say last night?
Hey, good morning. Thanks for having me. So, listen, I think Lauren's been putting out news left and right? I mean, there's news that's coming out here. And I think what's important when we reflect on what the company said, they're very good with their words, and they said they're not halting all production. So I think the reality here is clearly this hit on something that is actually happening. To what extent they're shutting down all factories as opposed to shutting down a lot or shutting down some, that we have no idea. But that was the refutation. So I think that that is important. So that's a nuance that we do know, or as you can imply, that the CNBC report had something to it. So I think, listen, ultimately taking a step back, though, Peloton has had a supply-demand mismatch since the beginning of the pandemic. Unfortunately, we've now inverted which side was off sides. So during the pandemic, tremendous demand, not enough supply. Now we're seeing the inverse.
We're seeing the inverse, and the stock has kind of cratered as a result. I think the question is, has the damage been reflective of all of the demand issues that we've seen? I mean, is there life for this company?
So, listen, I'm a Peloton user. I've been on more than one record stating that I love the product. I think there is absolutely life for the company. I think the question is, right now they're in the process of creating the strategic reset. So they're being very vocal about the fact that whether it's McKinsey or whether it's just going to be a focus on margins, the problem is they're talking about shifting to a variable structure. It's hard to cut costs with company when so much of your expenses are tied to sales. So R&D, sales and marketing, that's what it means to focus on variable spend. Pulling that back at the same time that competition is growing, that makes it very hard to grow. So I think the question we have is, does Peloton stop and take their 2.5 million members and just focus on those subscriptions, which have higher margins, and then not try to get anyone else and make sure churn doesn't grow? Probably not. And if they don't, then it's going to be hard to figure out where this profitability comes from. And that's when we continue to look at the cash burn.
Simeon, this problem of, a stock that took off because of demand during COVID, as people were kind of shuttered at home, they're not alone in this. We heard the same thing from Netflix last night. Reed Hastings saying on the call that they're having a hard time figuring out how much of this was subscriber growth that was pulled forward and how much of this was, people really didn't want to do it, what the growth expectations can be from here. So they're not alone in struggling with that. I think it's a problem that any team is going to be facing at this point. But your question is a good one. If they just focus on the existing base, what's the value of the company? If they go ahead and try and continue to grow and make sure that they continue to have a huge market share in this category, what's the expectation then? What do you say about the stock right here, $26?
We still have an underperformance. And I think the point you bring up is great. And I don't cover Netflix, so I can't really comment on the nuance there, but I would hypothesize that, and maybe this is wrong, but the problem or the issue is that they invested as if the future was going to look like the past. The problem is they laid down such heavy capital spend that it's not hard to just turn it off. It's not hard to just focus on those subscribers, right? Or it's not easy to just focus on those subscribers right now. So I think that we're talking now about the fact that the pandemic actually turned into probably the worst thing for this company, because if not for the pandemic, you and I would be talking about a hyper growth, very attractive company that didn't scale what it didn't have a protracted growth, and therefore didn't have to get this collapse. And what they sort of did was they ended up letting the pandemic dwindle their own cash as they spotlighted connected fitness and helped competitors raise their own funding. This is not a sector that's going away, and now we're going to find out there's multiple winners.